when a group is quoted in the traditional market, you simply just see what you're going to pay in premium.
Okay.
In a captive setting, you're going to see every aspect of where that premium dollar goes. You know how much is seeded to cover the risk. You understand how much is seeded to operating costs, how much each of the partners within the captive make and take on from a risk perspective. But the transparency through the financial statements is also a key driver. Understanding who you share risk with, how much risk is being shared within the captive is incredibly important. It defines how that program's going to operate.
Hi, and welcome to Captivating Health Insights. Today, we're jumping into our second episode on our mini-series on captive education. We're talking with Joe Parrilli, Chief Business Officer here at Captive Resources on the health solutions side. We are picking up from our first episode with Dave Gillis, who talked about moving from fully insured to being self-funded. Welcome, Joe.
Yeah, thank you, Madison. Thank you for having me.
I'm happy to have you here and would love for people that aren't familiar with you yet to understand what's your role here at Captive Resources and even your background. How did you kind of get where you are today?
So I was one of the few people coming out of college who wanted to do insurance.
That's amazing, by the way.
My whole family came from the insurance world. Out of college, I started as a group rep on the ancillary side. Came to Captive Resources just over 12 years ago and have been working to build up the health solution side over that time period. Today, have the opportunity to serve as the Chief Business Officer in our newly formed Health Solutions Department. And that includes overseeing everything from sales, captive management, and program management.
Awesome. And what do you mean by your family was in the insurance industry? What were you how were you shepherded in there?
It's all over the board.
Okay.
So whether it be brokers, the group rep side, everything down to the State Farm side. So I've seen all different sides of insurance growing up.
Okay. Well, that's awesome. Well, we're going to jump right in here, and I'm excited to talk about this kind of traditional stop loss versus captive stop loss because it's an important component of course, being in a stop loss captive. And this may seem like a really basic question, and I know we've talked about this in other episodes, but I always like hearing how people like describe it in different ways to break it down to help people understand, like at its most basic level, what is stop loss and how, like, what's an analogy of how you would kind of explain it to someone it's very new to the insurance industry in general?
I mean, stop loss is coverage for catastrophic claims. So you think of the premature babies, think of the large surgeries, the transplants, making sure that a company isn't on the hook for all of those dollars. They're buying insurance coverage above and beyond a specific point to make sure that they're covered for that type of risk.
And so how should employers think about the risk that they're taking on, and how is it different in the captive sense versus a traditional stop loss sense?
The risk related to stop loss is very much the same. Employers are still buying stop loss policies and contracts from A+ rated carriers in the marketplace. Where it differs is the ownership aspect of the individual captive. So now employers have skin in the game. They have the ability to see the inner workings of the insurance company, and they understand who they're sharing risk with. So they feel a sense of camaraderie and responsibility back to those folks to control their claims and perform as well as they can. But B, they have the ability to just follow the bouncing ball, and they know when they outperform based on the captive structure, there are dollars that have the ability to go back to them instead of being kept by an insurance company as part of their profit.
Okay. And what do you think is the kind of the scariest part, that maybe a misconception about getting stop loss through the captive? Are there any misconceptions you'd want to set straight?
There are a lot of misconceptions about captives, whether that be from a lack of education or potentially thinking one captive works just like all of the others. One of the biggest misconceptions is the captive is overpriced to be able to get dollars back.
Okay.
When in actuality, the underwriting entity is working to price the captive layer at break even. And when groups outperform that, they're the ones getting their dollars back in the form of dividends and distributions versus it being kept by that insurance company.
Okay. And for an employer that's already self-funded, maybe they've already made that jump.
Mhm.
They've been self-funded for a number of years.
Mhm.
What is a reason that they would want to consider now being part of a captive, even though they're already having that insight into their claims?
So we've seen a large number of self-funded groups transition into the captive. And going back when we first built our health captive programs, we focused it on self-funded groups making the transition. Why would a self-funded group look to make that change? To me, it's transparency driven. And it's also the ability to understand who you're sharing risk with and how much risk you're sharing. In the traditional marketplace, you're still buying an insurance policy from a carrier, which is
Mhm.
a year guaranteed policy, and then you're renewing and moving on to the next phase. In the captive, you have the ability as an owner to see the financials, to see where the dollars go, to see the operating cost, and then to understand who within that captive you're sharing risk with and how much. No different than any other business out there. Captive members see their financial statements. They see the financial statements of the company they own, the captive program. So it brings the self-funded aspect and the stop loss aspect, and then really puts it on steroids, letting people peel back the onion and see where all the dollars go and really the inner workings of the insurance company.
So it sounds like the transparency is the word that comes to mind for me
Mhm.
when you say that, kind of peel back the onion. What do employers need to know about the transparency changes?
When a group is quoted in the traditional market, you simply just see what you're going to pay in premium.
Okay.
In a captive setting, you're going to see every aspect of where that premium dollar goes. You know how much is seeded to cover the risk. You understand how much is seeded to operating costs, how much each of the partners within the captive um, make and take on from a risk perspective. But the transparency through the financial statements is also a key driver. Understanding who you share risk with, how much risk is being shared within the captive is incredibly important. It defines how that program is going to operate. So for the owners of the captive to have that insight, to be able to see the inner workings is key to having a successful member, but also a successful captive long term.
And what would you say are other kind of benefits that members see when they come into the captive arrangement?
To me, the biggest benefit outside of the transparency and just understanding the flow of dollars and where everything goes is that the success of stop loss is not just predicated on how your large claims operate. So, a major cornerstone of the captive is controlling total claims, not just trying to stop the large, nasty claims that a lot of times you could do everything right, they're still going to happen.
Hmm.
So when groups come into the program, they may come in thinking this is a financial mechanism. I'm buying my stop loss differently. When in actuality, they're joining a group of other companies who are looking at their healthcare dollar totally different. They are trying to figure out ways to drive total spend, not just focusing on the stop loss piece, which can be a small component of a company's healthcare cost.
Okay. And going back to what you had mentioned, we kind of touched on the benefits. What would you describe as the captive community that they come into? I mean, I hear this all the time as kind of the icing on the cake, or
Mhm.
like one of the main reasons that employers never knew that they would appreciate so much about being in a captive. What is that like?
So when you think of the total spend for healthcare, right, including stop loss and a self-funded plan, everything that the employer has to pay below a deductible, the stop loss piece is 15 to 20% of that total spend.
Hmm.
The claims that happen below an employer's deductible is probably 75 to 80% of their total spend. And that's what I was trying to get to when I said seeing the total healthcare dollar. People just think if I get a lower stop loss cost, I've somehow managed my spend, when in actuality, that's not the case. When you come into the captive, what you find are a bunch of employers who are going to do things differently, right? They all have different cultures. They all have different makeups of employees, spouses, dependents, where they're located, whatever the case might be.
Mm-hmm.
But they are all focused in different ways on finding unique opportunities to control their dollars, to control their spend for healthcare.
Mm-hmm.
And at the end of the day, what that does is it allows those companies then not to pass on increases to their end users, their employees, the people who need to go out and support their families. And the community in the captive spends a lot of time talking about that.
Mm-hmm.
How do they protect their most important asset, which are their people, their workforce?
Mm-hmm.
And in a world where double-digit increases have
Yep.
become normal, employers can't take all of that on and continue to function the way they do. So you have two options. You're either going to change benefits, probably not for the better if your costs keep going up,
Right.
or you're going to pass that cost down to the employees.
Mm-hmm.
Looking at the captive, the employers in the program are all sharing ideas. They're telling other companies what has worked, what hasn't worked, how they've engaged employees or families differently. So the power of networking, the power of sharing and learning and not having to recreate the wheel is one of the benefits of a captive that probably doesn't get talked about enough. Again, people go right to the financial aspect. How do we impact the stop loss?
Right.
But when you think about the impact to all of the dollars, the ability to be in a forward-thinking group, a group of people who are willing to try things that may or may not work, is one of the biggest impacts the community can have.
Mm-hmm. Yeah, it's interesting as that is actually the thing that drew me most to this job and this industry, because I was used to just working with employers that kind of felt like they were on an island. They're with their broker, of course, and their broker is helping them, but they don't really, maybe they have an HR group where they get together. Maybe they have some of those sort of, networking groups, but outside of that, they just feel like they're trying to figure it out on their own. And here, that community aspect is just invaluable.
And the captives and captive resources, want the brokers to feel part of that too.
Of
I
course,
think that's
yeah.
something that can't go understated.
Right. Yes. Thank you.
Whether it's captive workshops, whether it's captive meetings, webinars, whatever the case might be, anytime there's communication amongst the members, we hope those brokers are in lockstep.
Right.
And a captive shouldn't be forcing ideas on people. It should be facilitating the conversations.
Right.
And brokers may have other solutions that fit in that niche as well, which is perfectly fine. But we want them and their knowledge and expertise in the space adding to those conversations, not feeling like the captive's doing one thing and they have to try to compete with that.
Mm-hmm.
When the captive and the brokers are all working together and moving forward for those companies, that's when you really start to see the success take shape.
Mm-hmm. Yeah, it's really just making space to have those conversations.
Mm-hmm.
It's facilitating the opportunities for those ideas to be shared and
Right.
those conversations to be had.
Right.
That's great. And we often talk about reshaping the way that employers think about stop loss. What's the difference between kind of shopping stop loss and really, controlling claims?
The market has been conditioned to be somewhat of a commodity. So stop loss being shopped year in and year out is about finding the lowest price. But again, you're focused on 20% of your overall spend. When you truly focus on 100% of your spend, understanding that you could have a difference of a few percent within your stop loss cost, but you've made impactful change relative to your everyday claims, how people use their healthcare, what facilities they're going to for everyday medical needs. That's where you start to see the trend line and your spend line flatten out. Yes, stop loss is a piece of that, but at the end of the day, moving that by a few percent shouldn't overcome the idea of controlling and finding ways to impact your everyday claims.
Gotcha. And how does an employer kind of start that analysis process if they want to kind of model out what that could look like for them?
So again, we're talking about the financial aspect at that point.
Yep.
There are a lot of ways that you can look at the stop loss piece. But when you think back to the transparency of the captive and breaking down where every dollar goes, companies understand how much of their premium is actually in their bucket. So, what a group can do if they have claims information is look at the large claims they've had and look at how much would be in their bucket related to the captive and simply do an analysis. If your large claims would have exceeded the dollars you have, that would be a poor year and an assessment year. We define those in different ways. But if you continually have excess in your bucket based on your large claims within a defined captive layer, you know you would have been in a positive or equity position within the program. So doing those look back analysis when a CEO or a CFO or any company is looking to evaluate the program is largely impactful because it gives them a sight line into the financial aspect.
Mm-hmm.
Then it's incredibly important to talk about all of the other aspects that the captive is going to bring to the table, including the data analytics and the other ways to control the other piece that they're likely not looking at within that analysis.
Mm-hmm. And like you said before, they're doing this with their broker.
Mm-hmm.
Our captive resources rep is involved, but it's a team effort in terms of really analyzing all of the options.
Yeah, from education to analyzing the options to answering the questions, it's absolutely a team effort. We captive resources works through the brokers. We partner with the brokers to have the opportunity to do those analysis. But at the end of the day, we want to make sure that we're presenting that and explaining it to the end buyer who will make the decision if they want to become a part owner of that reinsurance company.
Mm-hmm.
But it doesn't work unless everybody's at the table together, hearing the same information, being educated the same way, and understanding the flow of dollars.
Mm-hmm. And what does it look like from like setting up a multi-year strategy and really kind of changing from a transactional
Yeah.
to more of a strategic move?
I mean, renewals still operate the same way, right? Stop loss policies are on a yearly basis. So every year you're going to evaluate a change in how the stop loss operates. Clients, broker partners all evaluate that differently, which is okay. Our team is here to work with them and do the things that are needed to make sure that all falls in line with their strategy. But at the end of the day, the multi-year approach is understanding that whether your stop loss goes up or down a few percent compared to where the market is, you are partnered up with other like-minded companies. You are looking at strategies. You are trying to impact that total dollar, as we've talked about, versus just continuing to shop the reinsurance.
Mm-hmm.
And there are other benefits built into the captive that help with that strategy. But year in and year out, we're consistently seeing 98+% retention in the health captive programs. And it's because people wanted to get off, as you said earlier, that proverbial island and start to partner with other companies who wanted to move in the same direction they are.
Mm-hmm.
And again, if you have an impact of a few percent up or down on 20% of your spend, but you're doing things to impact everyday claims, you're still going to have a winning proposition within your total spend for healthcare.
Mm-hmm. So if you kind of think about the theme of like controlling 100% of your spend, that 15% is the stop loss. You are controlling that, helping to manage that, and the 85%. So they're sort of in different buckets, right?
They're different buckets and they're controlled differently, right?
Mm-hmm.
You're not going to stop a premature baby. It's really hard to stop a cancer, things like that. But because of the way the captive is structured, the captive in totality tends to outperform the market that we see today, which continues to harden. So when you take the captive outperforming that mix, that's the 15%, and you have employers who are bought into controlling their everyday claims again, it's all about flattening the trend line.
Mm-hmm.
That's where we see the captive continue to outperform. And frankly, why members of the captive and groups don't go shop every year. Brokers don't need to go check the market every year because their groups are thriving within that mechanism.
Mm-hmm. So it's actually less admin or work in terms of the renewal. Like we're not shopping every year, maybe doing some of those things that maybe they were before.
Again, every broker and group is going to want to approach that differently, which
Yep.
is completely fine.
Yep.
But yeah, if you don't have to take a subset of the companies that you work with and go out to market every year and just do checks or whatever they're going to do,
Mm-hmm.
it probably saves a few golden bullets. It helps with a lot of things within that community, within that arrangement.
Right. Mm-hmm. So as we think about like what an employer, would need to know about stop loss, anything else come to mind as far as like barriers out there or just things to consider as far as what it means to understand stop loss in terms of a captive arrangement?
I think education is key. And what is happening is stop loss captives, medical stop loss captives, have moved from being an alternative to more mainstream,
Mm-hmm.
at least over the last 5 years. So getting educated, understanding the differences, understanding how you're currently funded and how that fits into moving into the stop loss arrangement is key for any employer. So I guess if you're asking for my advice for any group, it would be do the education, take the 45 minutes to an hour to really understand the mechanism in and out. And if you need more time, ask for more time to do it, because it's not just we could do it for a year and then get out. You can, but as you already talked about, these are really long-term solutions.
Mm-hmm.
So take the time to get educated properly. And for the broker community, do the same. Not all captives operate the same. So if you've heard education from one captive, you've heard education from one captive.
Yep.
So make sure to understand the differences, make sure to understand the nuances, and then make sure to understand the needs of your individual clients, because they're not all going to fit into the same solution.
Mm-hmm. Yep. And as we kind of close, we think about the future of
Mm-hmm.
captives. What do you see? Like, how do you see the captive environment evolving in the next 5 to 10 years?
Looking back, 5 years ago,
Mm-hmm.
educating the broker community or prospects on captives was a foreign concept, right?
Mm-hmm.
We at Captive Resources have been doing this on the casualty side for 40 plus years, but on the health side, it was still relatively new.
Mm-hmm.
Fast forward 5 years up till now, captives are mainstream. Like I said, there are a number of captive companies out doing education, which is great for the marketplace.
Mm-hmm.
In 5 years from now, 5 to 10 years, again, it's not going to be the alternative solution. I think for self-funded companies, 100 to 1,000 employees, it's going to be the go-to solution for many of them.
Mm-hmm.
There are stats out there about total market share. At the end of the day, groups looking to evaluate stop loss will, my opinion, will all at least have a captive quote or opportunity that they're also going to evaluate. Whether they take it or not is a different conversation, but it's hard to think that in 5 to 10 years, folks will evaluate stop loss without also evaluating if a captive's right for them.
Mm-hmm. Yeah, and we see retention rates that are very, very high.
Right.
So we don't see a lot of employers leaving
Right.
the captive arrangement. We only see, more employers, like you said, exploring this solution. And then it's, 98, 99% retention rate once they're in, because it is an effective solution. All right, Joe, any final thoughts for our listeners as we close out?
The only final thought I would have is just the education piece again. Get educated, find out if it would be a fit, whether you're a broker or a prospect. And if it's not a fit now, that doesn't mean it's not going to be a fit in the future.
Mm-hmm.
So the education is key. And then you can find ways to get your company or yourselves to a point that a captive could be a fit.
Love it. Awesome. Well, thanks for being on the podcast today, Joe.
Thank you, Madison.
Thanks for sharing your insights with us.
Yeah, thank you.